So good day. Here are the topics that was given to us in our LP, in LP4 to LP7, in banking and financial institution or the FM2. So the first topic would be the mortgage market and equity market. There are several types of mortgages. There are conventional mortgage, fixed rate mortgage, adjustable rate mortgage, and Federal Housing Administration loan. So, what is mortgage? It is a market that is underlying structure that supports home lending through mechanism and help with the free flow of funds so that the lending can continue. So, the for the types of mortgages, first is the conventional mortgage. It is a type of home or buyer's loan that is not offered or secured by government entity. So the next one is the fixed mortgage. It is referred to home loan that has a fixed interest rate for the entire term of the loan. So, next one is the adjustable rate mortgage. It is a home loan with a variable interest. And the next one is the Federal Housing Administration law. It is a home mortgage that insured by government and issued by a bank or other lender that is approved by the agency. So we can conclude that the federal housing is based on the government or it is insured by the government, while the first mortgage, which is conventional mortgage, it is not offered or secured in the government entity. So the fixed rate return is you can loan in a fixed interest rate in a entire term in loan. So the adjustable rate mortgage is for variable interest if you have a home loan. So there are common mortgages in offered by banks and financial institutions in the Philippines, which are chattel mortgage and real estate mortgage. So what are the differences between chattel mortgage and real estate mortgage? Chattel mortgage focuses on the movable property. For example, cars, jewelries, and etc. While the real estate mortgages is issued or is used for immovable property, which are lands, building, those infrastructures. So we are done with the mortgage. Now we can proceed to the equity securities. What is equity security? It is represents the ownership interest holding holding a shareholders in an entity, although realized in the form of shares of a capital stock, which includes share of both common and preferred stocks. So what are the types of equity securities are common stock, preferred stock, convertible bonds, warrants, depository receipts. So what is a common stock? Also known as common shares or ordinary shares or voting shares is the main type of equity security issued by the bank, while preferred stock receives dividends before common shareholders with fixed dividends. So another one is the convertible bonds. Is a bond issued a company that offers the bondholder the right to convert the bond into a pre-specified number of common shares. So the next one is warrants. So warrants are issued by companies to raise a capital and enough for investor to buy the stock in their firms. What is depository receipts? So depository receipts are not issued by company to raise capital, but rather issued by financial institution. So there are the different. So we can say that the warrants are issued to um, in order to increase or in order to raise the capital of the company. or encourage the investors, while in depository they are not issued by the company to raise the capital, but rather issued by the financial institution. So what is equity risk? Investing cash in a company's stocks usually risky than investing in so-called risk-free investments such as a government bonds. This is referred to as equity risk. So what do you need to know about the equity risk? So equity risk of investing in equity are share price falls, receiving no dividends or receiving dividends lower in value than expected. Another one is risk that the company restructure may make it less profitable. So that is my first topic. So the next topic would be in LP5, which is the LP5 talks about the derivatives markets and international market. So what is a derivative market or a derivative security? It is a financial instrument whose value depends on or is derived from some underlying security. It is an integral part of a successful risk management program because they offer an inexpensive means of changing a firm's risk profile. So there are types of derivatives market, which are forward derivatives, future derivatives, option derivatives, and swap derivatives. So derivatives work from the traded in and over the counter, and they are the same with future. It is a private contract to buy and sell the security. So for the future, they give the right to the holder to buy and sell assets to agreed price and date. So the options would be it gives a buyer the right to buy and sell asset at specified date and rate. So lastly, the swaps they allow parties to swap or exchange their financial obligations. So why derivatives are important? Because it is important because it facilitates the findings of prices and the transfer of risk for stocks, markets, and currencies. So for the topic 2, it would be the international money and capital market. International or foreign exchange markets develop so many people that can convert their cash to different currencies as they conduct business or personal affairs. Furthermore, payments across borders can be difficult to enforce and credit worthless can be hard to assess. Elaborate credit procedures have developed to facilitate international loans and financing. So, what are the roles of commercial banks in the international banks? It provides letter of credit. Commercial banks provide a financial products in the international market export and import transactions, accelerating the rate of capital formation, provision of finance and credit. It develops entrepreneurship. So the other topic would be the government intervention in foreign exchange market. It is the equilibrium exchange of rate of a given currency is determined by the supply of the demand for the currency. One of the roles of the country's central bank is to influence the value of the currencies relative to other currencies. If a government believes its currency is either overvalued or undervalued, the central bank can intervene in the foreign exchange markets by affecting the supply of a demand or its currency. So here are the government intervention in foreign exchange markets. Inform, regulation, mandates, and finance. Inform, it convinces consumers, providers, suppliers to behave in a specific manner, regulates how a private action may be carried properly. Some mandates is someone that is obligated to perform something and compensate for it. For the finance, healthcare with public funds. So there so that is the topic from LP5. So for the LP6, the chapter is 6 would be the commercial bank operations, international banking, and regulation of financial institutions. So what is a commercial banking? Also known as a business or institutional banking refers to a banking products and services designed for a corporations, institutions, and sometimes governments. So on the other hand, the international banking is just like any other banking services, but it takes place across different nations or internationally. To put in another way, international banking is an arrangement of financial service by a residential bank of one country to the residents of the other country. So the commercial banks would be here or the local banks. For the international banks, or from the topic itself, international. So derives from the other countries to the other countries. So that is the international. The combination of a lot of countries. So here are the difference between the commercial bank and the international banking. So the commercial banking provides a basic banking services to individuals in a small to medium-sized enterprise. Commercial banking also have generally been physically based, but an increased number now operate entirely online. So, for the international banking, it is a financial institution that provides or caters financial services outside the country. It is a multinational corporation benefit from the international banking facilities since they they may conduct business in many currencies. So, international banking also trade foreign exchange and trade financing. So, you would ask if what are the same, what are the what characteristics they have the same. So, it is a financial institutions. Syempre, another one is it transact export and import. It is the important part of the economy. So, what are the sources of bank funds? So, there are banks owned funds and borrowed funds. Bank owned funds came from its word own. It is an own capital of the bank. Borrowed funds, it is a borrowed money in a significant and critical source of funding for any banking organization. It is mostly derived through deposits, which are accepted on various terms in various accounts. So in banks' own funds, there are three types: paid up capital and reserve fund. Also, portion of undistributed profit. So in borrowed funds, it has a three types: borrowing from central bank and other sources, and the deposits. So the topic two would be the bank uses funds and loans of leases. Bank loans and leases are the primary businesses activity of a commercial bank. It is accounting for about 55% of all the bank assets. Although loans are very profitable to banks, they take profits and help attract deposits. Or or they take time to arrange, are subject to greater default risk, and have less liquidity than most bank investment have. So the last topic here in LP6 would be the regulation of overseas banking activities and financial institutions. Regulations have a major impact on how financial institutions are managed. So regulation of foreign banking activities or the International Banking Act of 1978, Foreign Bank Supervision Act of 1991, the International Lending and Supervision Act of 1982, the Basel Agreement. Also, the regulation of international banks are all host country all host country strictly monitor international banking activities. Changing legal regulation have been made world economy, more trade. It is a harmonization. It is from 1960s to 1990s. It had been a strong movement towards liberation in banking and allied fields such as securities, trade, and insurance. Last topic of LPs or the last topic of LPs in LP7 is thrift institutions, finance companies, insurance companies, and the pension funds. So, a thrift institution began the establishment of the customer-owned building society in the United Kingdom at the beginning of 18th century, while a thrift store offering a traditional savings account and home loan origination. This institution also offers checking accounts, personal and car loans, and credit cards for consumers. For the finance companies, it is a specialized financial institution that supplies credit for the purchase of consumer goods and services by purchasing the time sales contract of the merchants or by granting small loans directly to consumers. So the so the next one is the insurance sector. It's made up by the companies that offer risk management in the form of insurance contracts. The basic concept of insurance is that one party and the insurer will guarantee payment for an uncertain future event. Last one is the pension fund. It is a pool of money that is to be paid out as a pension when employee retires. So the second topic of LP7 will be the thrift institution and finance companies. So a thrift bank, also called a thrift, is a type of financial institution that is specialized in offering savings account and originating home mortgages for consumers, which tend to specialize in making certain types of loans. So many specialize in consumer finance, particularly small loans, others specialize in business loans, purchasing business accounts, receivables, or leasing. The business structure includes partnership, privately owned corporation, publicly owned independent corporations, and wholly owned subsidiaries of manufacturers, commercial bank holding companies, life insurance companies, and other corporate entities. So the last topic of LP7 will be the insurance companies and pension funds. Individuals and business face risk, which is uncertainty concerning the occurrence of loss. Risk takes many forms, including the risk of premature death or poor health, the risk of damage in property, the risk of legal liability, and the risk of individuals outliving their accumulated assets. Insurance have been described as the product everyone buys but no one wants to use. So pensions are used to protect against the risk of superannuation. So for me, the insurance company and pension funds are different because insurance companies have a wide or have a lot of benefits that can be shared to people. And while the pension funds are the funds that you earn from your working days, while you use it when you retire. But in insurance companies, um, you can use or you can have the claim if someone will die or that insured will die. The family of that insured will be the beneficial of the monies. While in pension funds also, you can have your own funds or you can use the funds that you earn from your working days. So that's all for today. That are my topics from LP4 and LP7. I hope you understand what I have talked about and what I've explained to you. So thank you. So as SBA student or a financial student management, It is important to me to learn these topics because for me, it is very helpful for my career, for my future career.